Good afternoon, everyone. Welcome to this rundown for global stocks and commodities for the 12th of March. I've been getting quite a lot of questions of late, and I've been mentioning this over the last couple of weeks that all the bearish commentators are really out in force at the moment, and the higher the US market goes and other global markets go, the noise from all the bearish commentators just gets louder and louder. So as a consequence, I'm getting more questions now from non-members in particular about are we reaching a peak? Is the market going to crash, etc., etc. So I want to start this week's edition with probably the most important topic because it seems to be on a lot of people's minds, and that's how do we protect our capital? How do we protect the profits that we have and still leave the upside open in case the market keeps rising further? In fact, I don't see any reason why the market won't continue to rise further with the normal sort of corrections along the way. So I just want to spend a little bit of time exploring this issue, and it's really a matter of perspective. There's really no requirement for you to do very much at all. So very much a perspective issue. So let's jump into it on how to protect what you've got and how to still leave yourself open to benefit if the market continues higher. So are the bearish commentators correct? Are we at a peak? Mark Faber is out at the moment saying that the market has got to crash, etc., etc. And there's plenty of others of them. Now, there are various studies around. I'm not going to go into a great deal of detail. You can hunt this down yourself if you like. But there certainly are studies around that show that technical analysis beats fundamental analysis every day of the week. And there's a couple of really key reasons for that. First of all, technical analysis gives you an immediate feedback about what the market is doing. If the market is going to reverse trend, then you know about it generally within a few days and most times within a few weeks. Whereas fundamental analysis, which may be providing you with updated corporate earnings or economic data, is monthly, or in the case of companies, quarterly or 6 monthly. And so therefore, if you've got to wait 6 months for the next set of earnings data to come out, then an awful lot of damage could be done. So one of the key reasons is just the response time. Technical analysis is far more sensitive than is fundamental analysis. The second aspect is that fundamental analysis is also about the market looking forward. It's making assumptions about earnings growth. It's making assumptions about the economy in all sorts of respects. And those assumptions may or may not be correct. So technical analysis is where your primary focus should be. I'm not saying that fundamental analysis is not important, because it certainly does have its place. And when you combine the two, it's a very powerful combination. But for those that hang their hat on valuation and fundamentals, I've seen plenty of companies that were supposedly great value and had amazing fundamentals, and the price went down by 50%. And probably about a year ago, I highlighted Apple, which did just that. There were fears that Apple was going to be a low growth company, and the shares dropped by 50% over a period of about a year. And then within another 6 or 8 months, the stock had just rebounded back to its highs. So there really is no substitute for using technical analysis. And as I say just about every week, my recommendation is that you stay with what is until it isn't. And those that have been trying to anticipate the end of the bull market in the States for probably the last 4 or 5 years have missed out on the most amazing rally, the most amazing wealth building environment that you would ever see. So trying to second guess the market and jumping out too early is just a fool's game. I just want to take a quick look at, just to illustrate this point at the big picture level about trends, and you want to try and stay on the right side of the big picture trends. Now I'm going to look at the S&P 500 and the 10-year US government bond. Now these should and do operate in the reverse direction. So money is either choosing to flow into stocks or into bonds, depending on how people view things. And these are very, very long picture cycles that also have intermediate and shorter term cycles within them. These are not timing tools. They're too long term, as you'll see. But it certainly does illustrate the point. So let's jump to that right now. So we'll start with the S&P 500. We're looking at a monthly chart, and I've gone back to 1981. So you can see that stocks have basically been in a massive bull market with two punctuations, one in 2000, so 2000 to 2002, and then of course 2008-9. Other than that, we've had some amazing rallies. The market got ahead of itself in 2000. It got ahead of itself in 2008. And some might argue that it's getting ahead of itself now. And I think on a big picture level, I don't have a high degree of confidence that this is going to continue for terribly much longer, but it could be another 1 to 2 years. So you've got to remember, this is really big picture stuff. And to really illustrate that, so stocks up, and at the moment stocks are still going up. The moving averages are still robustly heading higher, and the price of the index is significantly above the moving averages. That indicates strength. Now, one could argue that the price is too far above the moving average and will suffer some sort of retracement. And I agree absolutely, but that's no reason to fear that the market is suddenly going to crash. Let's turn now to the 10-year government bond, and again, this is going back to the 1980s and on a monthly chart. So interest rates peaked at 15.5% on the US 10-year in 1981, and then you can see bond yields dropped incredibly from 15.5%. We got down to 1%. And it would appear, it's not really looking evident on this chart yet because of the lag that's involved, but it would appear that this 35-year bull market in bonds, bear market in interest rates has come to a conclusion, and that we're about to turn higher. It's not absolutely definitive yet, and we'll look a little bit closer than that. But just to get a sense of the lag that can be in these charts, if you look at the 50-month moving average, it wasn't until 1984 that rolled over. This peak was in 1981. So there's a 3-year lag here to the 50-day. And there's only a 10-year lag for the 200-month to roll over. So these are definitely not timing tools, but they illustrate the point that there are varying cycles in different time frames, and you've got to make sure, first and foremost, that you're on the right side of the really big picture stuff. Now, let me just go down now to a weekly chart on the TNX. So this is the 10-year bond. So you can see that we're starting to get a bit of a turn up in the 200-day moving average. We've had that before. We had it in 2006. So we may get a rise, and then perhaps, in fact, this chart seems to indicate that we probably will get a bit of a rise. It's how it plays out over the next couple of years that's important, and I'm not making any bold statements that this is going to suddenly go back up in a hurry, because I think if it started to go up too quickly, then the Fed would just step in and do something to prevent that rise. But it does give you the sense that we're now back above the 200-day moving average, the red line, and the red line is starting to turn up. So at least we're getting a bit of a positive there. If you look at it on a daily chart, you can see this substantial rise. So you can really see how powerful this rise has been since, well, basically since the US election. The interest rates have really shot up quite strongly in anticipation of what Trump is going to do. So I just want to make a few other points. The first one is, in all this analysis, you can get terribly detailed and confused. Keep it simple. It's just the best way to approach the market. Now, I've done this several times before, but I'll do it again, perhaps for people that are new that are watching this video. This process, which is very, very simple, anyone can do this, would have got you out of stocks in 2008. You had 4 months to get out within 14% of the peak. So I'm sorry, I do not have a formula or a crystal ball that will get you out at the top. Can't do it, can't be done. But in this case, this would have got you out within 14% of the peak, which again, from a perspective point of view, if you had been loading up on stocks in late 2007 when volatility was clearly rising, and we'll see that, then you shouldn't have been, because that was not the time to be really building up into the market. So if that wasn't the case, then you didn't lose money in 2008 just by following this very, very simple process. It really is very easy to do. The only problem is that your mind has got to be open to what the chart is actually telling you. So the message out of this is, don't try and get the first or the last 10% of a bull market, which might extend for 5, 10, 15, 20 years. If you can avoid, if you can get the 80% in the middle, so don't try and get the first 10%, because that has not proven that we're necessarily into a new bull market and we get lots of false starts. And if you don't try and get the last 10% by trying to anticipate the top and get out as soon as the market flinches, then you leave yourself open to get the big 80%, the big meaty bit in the middle. And that's really, if you can just do that consistently over time, then you'll do extremely well. So my overriding advice is clear your mind of all the garbage that's put out there by the media and the commentators and what might already be in your subconscious. Keep it simple, be decisive, and there are people around that can help you retain that clarity. And that's one of the things that I'm trying to do through these weekend videos, is to provide some big picture perspective and clarity about what's going on in the market. So let's take a look at, let's go back to the S&P. We'll go to a daily chart. So I just want to go back to 2008. So let me just extend this out a little bit. Sorry, just let me get, no, it's not going to play ball with me. So if you sit there, sorry, it's not being kind to me at the moment. Let me try and lock that in. There we go. So I'll just go back a little bit further. Okay. So this is the period from 2003 to the peak in October, November of 2007. Very simple. Put a 200-day moving average, which is the red line, and a 50-day moving average, which is the blue line. And all you need to observe is the price behavior and the characteristics of price around the red line. Now you'll notice all through here, we don't tend to get very much in the way of pullbacks. We go under the 200-day moving average for just a very short period of time. This was more sideways than down. This was only under for a few days. Same again here, same again here. And really, you've got to go all the way through to here, which is July 2007. So you stay with what is until it starts showing you that the character of the market is changing. Now, we had a sharp plunge that was sharper and deeper than anything that we'd seen back from here. That occurred in August of 2007. This is 12 months before the market crashed. And that's why I'm so relaxed about the fact that we're not about to suddenly crash this market. Almost always after this first initial sell-off, which is when the really smart money starts bailing out, you get another surge. The people that still believe the market has got plenty of legs. Whether it forms a new high or a lower high, it doesn't really matter. This is your first warning sign. Now, this is not proof that the trend is going to change, but at least you should be on alert and you should be prepared to change your position if there is evidence there. Now, we went up, we formed a very marginal new high and then came off it straight away. We came down, formed a double bottom. We bounced to a lower high. At this stage, the 200-day moving average has still not rolled over, but here was the point where it broke these lows. So there in January, 14th of January 2008, still some 4 or 5 months before the real nasty part of the 2008 crash occurred, that was the sign that you should be significantly winding back your exposure. And it really is as simple as that. Now, for those that even didn't respond to that, we were still mucking around from January, and there was another high formed in May. So you had 4 months in this whole period here to make the decision to significantly change your stance on the equities market. And that's why I just will not accept that that you're going to get caught out by some sort of crash in the market. And if you look at every peak going back in history, they all look similar to this. So then, of course, the market really plunged a long way and then started to recover. And you can then just go into the reverse mode for the recovery. So that's why I'm really comfortable and confident that we're not suddenly going to see some sort of major 6 to 12 month market top that's going to strip away a lot of value from the market. There's just no signs of it at this point in time. And you can see we've had a bit of a pullback. Last week I marked this zone as the zone retracement zone to look for. So far we've just gone down into the top part of that retracement zone and then we bounced. I don't know how this is going to play out, but I would be surprised if we break 23.46 at this stage. Now, just looking at some of the other indices, this is the NASDAQ. So there's the NASDAQ index, still roaring ahead, well above the 50-day moving average. It is a bit unsustainable up here, I must admit, but it's still got plenty of horsepower behind it. Let's look at the Russell 2000. Obviously, nowhere near as robust as the NASDAQ, but nevertheless at all-time highs, not really pulling back, just going sideways. We've got a little bit of a restriction in breadth in the market, but again, nothing that sort of indicates a significant change. Okay, let's go back to the slides. So where are we now? Well, as we've been seeing, stock indices are still in uptrend, and so the big picture is still all good at this stage. There's no reason for you to be making a substantial, bigger picture reassessment of the market. Now, depending on what kind of trader or investor you are, you may want to make some adjustments for the short term, but if you're a long-term trader or investor, there's really no need to do very much at all. So we've got stocks up, we've got bonds down, as we've seen, and therefore interest rates rising. We've got gold, as we'll see shortly, is still quite choppy at this stage. I don't think you can really say what the heck's going on with gold, but it'll resolve itself. And the three strongest sectors over the last 3 months are technology, finance, and industrials. They're the three outperformers in terms of price. And they've also been pretty strong on earnings as well. So we can then further dissect that. And within technology, the strongest sectors in order are hardware providers, internet companies in various forms, software providers, and the semiconductor sector. So they have been the strongest parts of the strongest market that exists. Within finance, banks, insurance companies, and specialty finance companies have been the strongest amongst the 15 or so categories within finance. And within industrials, we've got aerospace and defence, we've got railroads, and we've got machinery manufacturers. So with all those opportunities, literally hundreds and hundreds of companies within those three sectors, why not just focus on that? Why worry about anything else? Why worry about tips? Stay with what is the strongest, and you're going to be on very solid ground. So that's why I say just keep it simple. You don't need to do anything fancy or complex here. So turning to the American market, um, the S&P was down by 10 on the week, and the 20-day moving average provided support, as I indicated last week, that it probably would. Now we've had a solid earnings season, and now we've just had a second really excellent jobs report on Friday night. So there was a really good one in January, and now an equally good one, if not even a bit better, occurred in February. I just want to address the valuation myth as well. A lot of people are, they're using the Case-Shiller index and demonstrating all sorts of wonderful looking graphs that show the PE ratio at 30 or whatever. I don't really understand why you would want to use when the stock market is a forward-looking animal. Why would you want to use an index that used historical earnings? In other words, earnings that are already redundant and redundant by anything up to 12 months. I mean, why would you want to do that unless you're just trying to make a point that the market looks overvalued? So for me, because the market is a forward-looking instrument, and that's how stock prices are being determined, then I want to look at the earnings this year, 2017, and I want to look at the forward estimate for 2018. And if you apply the earnings growth at just the normal historical average, nothing fancy, just the long-term averages that have existed for the last 20 or 30 years, then what you find is that the 2017 and 2018 PE ratios are 18 and 16. And that is quite in line with the long-term PE ratios. So I just don't buy into this argument that these numbers, the data is being selectively chosen to show that the market is at an extreme level of valuation. I just don't accept it at all. Turning now to Aussie stocks, the Aussie dipped, got just under 75 at one stage, but rebounded a little bit when the US dollar slipped on Friday night, finished at 75.5. The Aussie index, for the record, was up 45. But look, there's very little going on in the Australian market. It's pretty much trendless. Let me show you the index. But most stocks are looking somewhat similar. So yes, we've had a sorry, this is really playing up on me a bit today. So yes, we've had a run from the lows in January. So there is a trend there. But at a bigger picture level, you can see we're still well below the highs of March 2015. And really, since this breakout at 5,600, we've run up to 58 and we're still stuck in it. Now, that might change. That might break out. I kind of hope it does, because I get sick of saying how uninteresting the Australian market is. But at the moment, if you want to go with what is, you compare the Australian market, that's the index, compare that with the S&P, just get it on a daily chart. There's just absolutely no comparison. It's chalk and cheese. Say no more. Turning now to precious metals, gold fell below $1,200 on expectations of a rate hike in the next few days. It lost $35 on the week, which is a pretty decent decline. The GLD holdings, so the world's main ETF for gold, slipped a little bit. It had got up to 841 tons. It slipped a little bit to 825. That's not a great deal, and it just kind of, I would have been a bit surprised if there hadn't been a bit of selling in the ETFs, but at this stage, that's reasonably mild. Now, as I'd indicated 2 weeks ago, when gold stocks did make that sudden 10% breakdown out of nowhere, and I said that, or I posed the question, were stocks telling us where the market was going? And the answer, yet again, for the 99th time out of 100, is yes, stocks were leading the way. But they've let us down. They're now showing some stability, and we saw some nice turnarounds on Friday night. We'll look at that in a minute. Now, the point I want to make is that the fundamentals about gold stocks in terms of their profitability, their debt levels, etc., are really great. These companies, or sorry, I shouldn't say all, a lot of the best gold companies in the world, the fundamentals are great. The sentiment at the moment is awful. So short-term sentiment has been weighing on the share price, but as long as the fundamentals are great and earnings are still growing and the price of gold's not going to collapse, which I don't believe it will, then eventually we're going to see a turnaround. I'm not quite sure what to make of this, but I just throw it in as a piece of perhaps slightly trivial information. Russia purchased 1 million ounces of gold in January. Now that represented 15% of global mine production for the month, just to give you a sense of how significant that was. That is huge, and it follows another very huge purchase just before the US election in October. What is it telling us? Is it telling us that Russia is fearful about all sorts of things to do with the world's financial system, and so they're increasing their stock of gold? Is it signaling that they've got some other plan in mind, like perhaps the Chinese have in mind, to eventually kick the US dollar out of being the world's reserve currency? I don't know. I'm not going to spend too much time thinking about it, but I just think it's interesting when a country like Russia makes such a massively huge purchase of gold in January. So I just repeat again, I think everyone should hold some gold or gold stocks. I think that's essential, but do it in balance. And at the moment, until we see some more evidence that this rally is going to continue in gold, then I wouldn't go overboard. So let's take a quick look at the gold sector. It's going to be a little bit of a longish video this week, but the feedback I get is most people don't seem to mind. So this is silver. So if we pan back, here's the big rally in the first half of 2016. Here's the big crash in the second half of 2016. We then had a really strong rally. We've had a pullback. We're overbought. We're oversold. But as we'll see in a minute, the stocks are starting to find a bit of stability, and that pullback is just normal to be expected. Although I do note that we still are forming lower highs and lower lows, although I suppose you could say that we've now gone above this high. I'd feel a bit more comfortable if we can get up above here. Looking then at gold, so this is gold on a daily. So there was the pullback, but you see a bit of a turnaround on Friday night. And if we flip to GDX for gold stocks did even better, and you can see there was quite a nice volume rise as well, and there were some individual gold stock rises, anything up to 8% on the session. So I think there's every chance that we may have seen the pullback in gold, let's see what next week brings. Now turning to other commodities, copper dipped to about 253 from memory, and then rebounded, so it ended up at 259. This was really about currency movement. Long term still appears very bullish to me. Now the big move of the week was crude oil. It got smacked down very hard from 53.5 down to 48.5. So the trading range that I've been talking about now for some time finally busted. A big inventory build up in America of oil stocks caused hedge funds to basically unwind their long positions, and they did it in a pretty untidy pattern. And generally when you get falls this sharp, there's generally more falls to come. So I wouldn't be surprised to see oil go down and test 45, and depending on what the Saudis do, we may even go lower. So do not go trying to pick a bottom in the oil market yet. Way too early. Here's some charts on oil. This is West Texas Intermediate crude. There's the 10 years. So you can see we had that massive run up just before the crash in 2008, got up to $145. We then had the crash, a recovery to 100, and then this latest crash as the US shale oil drilling really ramped up. Zeroing in on this last part, so zeroing in on this last year here, that shows you the dimension of that plunge on Thursday and Friday nights, really very sharp. So that's the crude oil market, so stay clear of it for the time being. There's the spot copper chart. Not a lot of movement on the week. So to wrap it up, just yet again, keep it simple. Stay focused on your plan. You don't need to do anything really fancy. Just go through this video again and just try and keep this sort of simple big picture perspective in mind and shut out all the garbage. The big gain in the US stocks since the election is bothering many people, and you've got to ask why. Just because the market has gone up is not a reason in itself to be fearful that the market's going to crash. Now, sometimes significant tops in the market do occur after a sharp rise, but just because it rises doesn't mean that's a reason for a pullback or a significant pullback. So, just get rid of that thought. Is there a case for some prudence here? Yeah, I think there is, depending on your time frame. If you're a shorter to medium term player and you don't like seeing some of your profits evaporate, then possibly yes, maybe trim your portfolio back. And depending on your circumstances, if some of your positions that have become very profitable over the last year or so have become excessively large, and certainly we've had some in both our investor membership and also in our trading membership. We've had some positions that have gone up hundreds of percent and have become extremely profitable and extremely large. It's time to trim some of those positions, and we did that in the trading program, as members will know. Just step back and consider your reaction if the market went into a 5% decline. How would you feel? And if the answer is you're comfortable with that, then I think that's about all we're going to get at the most. So if you're comfortable with that, then there's really no reason for you to do anything. I'll be quite surprised if we get anything bigger than a 5% decline. If we do, I think it'll be due to some event, but not an event that changes the trend. Yes, there can be an event that punctures sentiment and the market drops 10%, but if it hasn't changed the big picture fundamentals, then the market will just bounce straight back again. So I don't think it's worth being out of the market for that. So that wraps it up for this week. Sorry, a bit longer, but I've just really have been getting a flood of questions, and so I just wanted to provide that perspective. There's my contact details for non-members, and I'll look forward to another fascinating week and be back to you next Sunday. Cheers.